A warm welcome to everybody out there. My name is Stefan Friedrichowski, and I welcome you to our next webinar with the title Martingale Trading Strategies. And I welcome you as well in the name of JFD, who made those webinars possible for all of us. So it's a pleasure for me to have you once again here within that webinar. Even it's more a webinar series, but yeah, it's really fine to have so many people always here. For the records, yeah, today we have the 24th of July, so the year goes on, and yeah, today's topic will be maybe a little bit exciting. It's a little bit concept-like. So you will see some more even strange approach about trading. So yeah, that's what we do today. But especially today, I have to make the remarks as always, especially the risk disclaimer I have to show here once again, because what we talk today is really risky trading. And that kind of approach is always inherent risky when we talk about martingale trading strategies. So that risk disclaimer is even more important today than within other webinars. That is the one announcement I always do. And the other one is that you may already download the slides of today's webinar. Oh, I see. Maybe I have the wrong ones. Let me see. I hope not. So maybe they are in German, but anyhow, if there's something wrong, then please remind my email address. You can always get in touch with me direct via email. So therefore, no problem. I'm just wondering, but I think I have not renamed the slides because there's a GE for German within, but maybe I've simply not renamed that file. So you can download the slides if you want, and later I will show two Excel sheets. If you have interest in those, you can have them, of course. Just email me and yeah, then I will send them around. So today's topic is martingale trading strategy, and in detail, I want to cover four aspects today. The first one is a little bit to look what is the real origin of martingale strategies, because it has a long history. It's known since centuries, even before we start trading like we do today. So it's a quite old concept, and we will look to those origins as well. But having done that and look a little bit around what does it mean, then we can try to set up a martingale trading concept in general. And there's a lot doing like, yeah, you buy if you lose. And you will hear a sentence like that quite often today. And you know that normally one would not do that. But today, let's look into that kind of concept and how that works. And finally, because originally martingale strategies are strategies with unlimited risk, and that sentence you will hear once again quite often today. Therefore, the question is valid to ask, can we tame that kind of concept? And indeed, there are possibilities to tame that kind of concept. And finally, I want to show or share with you, let's call it a live experiment. So I will switch to an MT4 account and will run an M1 expert advisor with Martingale in order to visualize the concept finally. It's not meant that we will have within 5 minutes a couple of euros earned, but it's finally quite well to see the kinds of concept. So Martingale, the origin of Martingale is from the roulette table. So we talk about casino, and therefore you see already that it's risky what we talk today. So the concept of martingale trading games. It's even meant not only at the roulette table, but that is the most common game to go for martingale strategies. And the logic is in that kind of in the original behavior is really, really simple. What you do is at the roulette table, and don't mind that I will forget the green zero, that this is possible as well. So normally what you can do is you can bet on red or you can bet on black. So let's simply, for simplicity reasons, we forget that there's a zero and this one might be green. So you either put your money on red or you put it on black, and then the wheel goes around, and yeah, finally you have lost exactly what you put on the table, or you get exactly the same amount back. That's the complete logic of playing roulette, and not playing the real numbers on the table. And the concept or the rules are that simple. If you lose, you double your pool, you double your money for the next game. That's all. So if the first, let's call it a trade because we are trader, is a loser trade, then you double your pool. That's all. If you finally win, because it might be that there are 3 losers in a row, which always means you double already. If you finally win, that complete sequence is now a winner. And then you go back to your original pool. So the original money, let's say €1 or €5, and that's all. That's the complete concept of playing martingale at the roulette table. And nice anecdote here about that, because I will later go to that website, just that you have an impression of that there's a lot of math behind. On the German variant of that Wikipedia article, there's meant that Giacomo Casanova has been a gambler with that kind of approach, and later you will see that you finally will lose all your money. Yeah, and that happens for Casanova as well, but he found other ways to survive, and now I'm a little bit laughing, and hopefully you too. But let's just that you see that kind of system or that kind of article. So that is mathematically described how it really runs, that you double every time you go for, and the calculations you can maybe follow. I can recommend, if you are able to read German, the German one in this case is a little bit better or a little bit more impressive. But anyhow, so you can find that Wikipedia article about Martingale as well. But what we now will do is we look for that kind of approach just from an Excel point of view. So let me go here into that Excel sheet, and what I have here prepared is what we exactly do at that roulette table. And then because we are trader, we like equity curves. I plotted exactly an equity line here as well. So, but first, let me describe a little bit how that Excel sheet runs. And if you have been within other webinars, you have seen already more or less the same Excel sheet already when we talk about trading statistics. But now I simply introduced here that kind of doubling as well. So that's now in German, but anyhow, so the original pool is, so the original money I call it invest or put on the table is here €5. And since I forgot that green zero on the table, my probability of winning or losing is exactly 50%. And then that Excel sheet runs quite easy. So I have a random number here, and if that random number, and the number is always between 0 and 1, if that number is below 0.5, so our threshold here, then we have a winner trade. So that means, comparing to the roulette table, we put our money on red, and indeed red was coming later. So what happens? Our pool, our money in was exactly €5, and we gained that €5. And since my account or my wallet at the roulette table starts with €200, I have now 205. So okay. So second round, second try. Since the first trade was a winner trade, we go for now for once again with €5, but now we lose those €5, and you see account goes down to 200 again. And so it goes on, and as you see, there comes a couple of winner trades or winner rounds here, and now here you can see exactly what happens if we lose. First time we have had that example already, so account goes down by €5, and then we double our pool, and we lose once again. So that means our account goes down by €10, and so on and so on. But now, next year, we have a winner. And you see what happens. Look to the equity line, and it's not magic. It's always looking like that. But you see already something which is quite important to recognize. You see that there happens sometimes those deep cuts down. So we went really to the south, and if I scroll down here a little bit, we might see, oh yeah, we have already been at a pool of €80 here in this case. So if that would have been a loser once again, we would have been at 160. And therefore we get equity lines which have those dips. Finally, there's a winner trade once again, and since we doubled always, we go back here straight up. But now, since I have an Excel sheet with random numbers, I can do simply what I always do with those random numbers. I simply press F9 and we get a new sequence. Let's see what happens. Oh God. It starts quite well. So we have here in total 100 of those sequences, and our account went up. Perfect, very good. And then we have that kind of event. And now let's look realistic on that. That would mean after 93 trades, or however we call that, we have lost all our money. So therefore that curve crosses the zero line. So indeed what I would have to do here is either to look whether I have additional money in my wallet, or I have to leave the table. So, but you see what happens here, and you might compare that to trading as well. Exactly the next trade was the one, and we went up again. So if you look to that kind of concept a little bit more from a mathematical point of view, you will see we always get that straight line upwards. But there's always such, not always, but in most cases, we have those deep dips downwards. And let me, that you realize that a little bit more. I have here just a row of 100 sequences that you see how often that happens with those kind of things. Let's go here for a longer sequence. So here we have in total 1,000 of those bettings, and we start here now with €1,000, and okay, this equity line is still absolutely okay. And your gain, your average gain, by the way, is €2.50 here about, and that equity looks quite well. So if you would have that in your account, in your trading account, I think you would not be that unhappy. But now let's do the same here once again. Press F9. And you see, okay, within 1,000, 2 times I went bankrupt. Here, okay, only 1 time. Here, 1 time, and so on and so forth. Here I survive. And you see, yeah, that concept is not that bad, but sometimes we do not survive. Formally speaking, we would always survive if we have unlimited resources. That means unlimited money, because we can always go out of that dip by doubling for the next betting. So to some extent, it looks quite interesting and nice, but on the other hand, let's be realistic. Who of us has unlimited resources? I don't have them. And you, I most probably think you don't have unlimited money as well. Formally, looking to the roulette table, there's another limit. And since the casino owners know exactly that kind of strategy, they have done something quite clever. Because there's a limit of betting at every roulette table at the world. That means finally, maybe that limit is 1,000 euro, or maybe that limit is 10,000 euro. And that means you cannot double anymore if you come to that limit. And then, indeed, that strategy is ruined, is not any more valid. You need that doubling for that kind of sequence. So what we learn now here is, in principle, concept does not look that bad, but we have to think about how to manage those dips, and those dips should not be set that huge that we go bankrupt. And indeed, there might be things how to tame it, and that is exactly not exactly the next topic, but we come to that as well. So first thing here is that we realize, okay, the Martingale approach. With that Martingale approach, you go bankrupt by guarantee. And let me go quickly to the slide, because I have that on my summary here, intermediate, let's call it an intermediate summary already. So on the one hand, the Martingale has nice, continuously increasing equity curves. Okay, so that makes us as a trader absolutely curious. But the downside, as shown within that Excel sheet, is that bankrupt will come by guarantee. And I mean really in 100%. You may survive for 100 trades or 100 bettings. You may even survive for 1,000. But if you would do it every day, there will come a day after you earned already some money that you will lose all. And with all, I mean all. So in principle, it does not look that bad, but we have to adapt and we have to tame it. But now let's look to it from a trading perspective. And let's put our knowledge of trading here into that concept as well. So we know from trading that every trade needs a stop loss. Okay, that's good. On the other hand, just from the Martingale approach, we know if we only introduce something like a stop loss, then the concept will break. So we have to be a little bit more tricky on that. So in our language, that would mean we have a fixed risk value in euro. And later you will see I use that as a final risk value, or the panic stop loss, or however you call that. So the first trade, for that first trade, that final risk value will be in a way that the stop loss is really far away. But then we build up something like a pyramid, but on the other side. Let's see. You will understand perfectly, I think. So we know from trading we need a fixed risk value. Let's assume we just put it in euros. And what we want here is to gain a certain profit. That's from trading as well. We know take profits are good. So let's think with every trade we want to earn a certain money, amount of money. Finally, you will see that when we talk about trading, the risk-reward ratio of that kind of approach will be far below 1 in this case. But let's see how that works. That kind of doubling in the roulette martingale approach, I don't think is good. Let's put that linear. What does it mean? So we open a trade, and if we open that trade, and I will present you a sequence of those in an Excel sheet, and we do it together, then you will perfectly understand what I mean. But we set us a limit. After a certain loss, we buy again. So think about you buy the DAX and then you encounter a loss. Well, not the trade is already in the stop loss. Stop loss is still far away, but we have a long trade. DAX goes down, but what we now do is we buy again. And that means that our average entry price will go down, which is nice. But still, we think in trading aspects. That means we have a stop loss and we have to now shift that stop loss. We will do it in that Excel sheet. Before going there, please note what I'm now talking here is exactly, you get warnings about that in every trading textbook. And in principle, I agree with to make your trades cheaper by rebuying is not the brilliant idea you might go for. But maybe we can do it professional, and then it will give us another picture of that. But normally, that is not a good advice to rebuy if you encounter already losses. Let's do it together. And in this case, later I will show examples about Forex, but that will be later. Now, because for simplicity reason, I simply go for an example with the DAX. And with the DAX, I will do now the following. I take the DAX because then I can do every calculation without any calculator. So what I assume is that one DAX point is simply €1, and all my trades now will be in units of one lot. You might think at JFD, you know, that you can buy 0.1 lots for DAX. I could scale down everything here, but for simplicity reason, I go for one lot, and 1 point is always €1, and then everything we can do straightforward. So let's assume we have those values, that we have a total risk of €500, and that we want to reach a target of €100. And you see, risk-reward ratio is far below 1, and that will be our rebuys. And that will be later the average. So let's go, and let's simply start with a trade. We go for a long trade. That's now the direction for that example. So we buy the DAX at 12,200. Okay, that is now our price entry. Sorry for all the German words here, but anyhow, of course, our average price is 12,200 as well, no question, because we just have bought it. We have no floating losses. Spread is 0, no commission. So for simplicity reason. But now let's think about our take profit and our stop loss. Okay, since 1 point is €1, calculation is easy. So what we know is if we buy at 12,200, then take profit is 100 points above, because we have a target of 100 euro. Okay, got it. Stop loss is 500 points below, far away. Perfect. Now let's think in days or in whatever time unit or time frame. I don't care really, but let's see. If DAX went up by more than 100 points, okay, then everything is clear. We reached our take profit and we are happy and everything is fine. But now let's think DAX goes down to 1200 and 130. So by 70 points, DAX goes down here. Okay, that means right now we would have a loss, a floating loss of minus 70 euros. Okay, and now that triggers the next one, because we have now a loss higher than 50 euros per lot, because we bought first one lot and now we have, since we only have one lot up to now and we have already a loss of 70 euros, then we have to rebuy. Okay, let's rebuy. We buy for that price here, 12,130. So that means our average price now is simply 12,165. So that's our average, our average entry price. Now we have two lots. Since we now have two lots, our take profit comes towards the price. So what we have now is we have an average of that, and our take profit is now our target value divided by the total number of lots we now have, and we have two. So that means our take profit is now at 12,215. So hey, that goes down. So we need an increase of 50 points now to reach our target. Good. And that is exactly what we want to have, that the take profit comes towards us, into our direction. The downside is that since we are professional traders with stop losses, we have to manage our stop loss once again as well. So now, since we have an average price here, our stop loss is our risk, and also that divided by the number of lots we now have in our account. So that means stop loss went up to 11,915. Okay, once again, next day, let's see. Okay, if DAX went up here to our target value, everything is fine and our trade is managed. So in case the DAX might only go down, let's say to 12,120, then right now, what is our current loss? Okay, our current loss we have is our average price and our our average our current price minus the average price times our current lot size. Okay, we have now minus 90 in total, but per lot it's 45. And simply setting those kind of rules, in this case, I would not rebuy anything. I would go with that position, since that would mean we have still the same number of lots. Take profit and stop loss would not be changed. If in case that number would be a little bit further down the road, then we would have to rebuy once again because now our floating loss would be minus 110 euros, and that would trigger in that kind of logic. And you can think about other logics as well, but let's keep it quite simple. So if our average loss per lot is exceeding the 50 euro, which is now the case, we would rebuy once again for that price, 12,110. Okay, let's go for that. So we rebuy here, and our average price went down once again. And now I can use simply that one here, and let me take out all the digits, or nearly all the digits, because otherwise we cannot see the numbers quite well here. But now we have it, and you see once again our take profit comes towards us. Now we need 34 points to the north, and our trade reaches target. But of course, our stop loss comes towards us as well. So you see how that concept in principle works. So you make your entry price cheaper in that long sequence here. The amount of increase, the pullback now you need to reach the target comes closer, closer, and closer. But on the other hand, the stop loss comes closer and closer and closer as well. So we still just playing around with that logic, be sure, is nothing else than the Martingale approach. And you would lose everything with guarantee, since we need something else. Just playing around with money management and lot size amounts cannot save us. If it would be that simple, then it would be nice, but it's not that simple. What is good on that logic is that our take profit comes closer to us. So we need those pullbacks. Even so, in this case, we started a long trade in the DAX. DAX went down. Okay, of course, we encounter floating losses here. But in order to recover and to hit our target of that trade, the number of points we need for the DAX going to the north becomes smaller and smaller and smaller. So think about if the DAX is not going down in a straight line. It has from time to time those pullbacks. So even not that big pullback would already recover our trade. And finally, we would hit our take profit. But just looking to the numbers, you see exactly what we need. I call now a trade such a group of trades like here. So we need 5 groups hitting the target, and then we can have at least one of a loser trade, and we would lose 500 euros. So still, it's not the concept we can trade directly and we would earn money, because just from a mathematical point of view, it's still nothing else than what we have had at the roulette table. But now we can see maybe there are other things we can put into that basket here, and then we get better. Let's see. Okay, let's go back to the slides. So we can draw already some intermediate conclusions of that kind of system. So we have some pros, and still we have a con here. The pros is now, since we look from a trading perspective, we have a stop loss. We have a limited risk. That's always good. And within one group trade, we can only lose a certain amount of money. Good. That is well done. So In case we are on the losing side, so we open our trade, let's call it in the wrong direction. So as in my DAX example, we open a long trade and DAX goes down. What we only, in brackets, need is a pullback. And then we can turn the trade already into a winner trade. That's good. But now think about a little bit more about what you have seen in thousands of charts you have seen in your life and maybe on a daily basis. There are always phases which we would call as a trader sidewards phases. So price is just wiggling around, choppy market, no trends, it goes up, it goes down, whatever. That phases now become ideal for that kind of approach. Because if those straight behaviors into one direction are not too far, which would finally mean we would hit our group stop loss, with every pullback, we turn our trade into a winner trade nearly every time. But only if that straight behavior into one direction is not too straight in that one direction. And what we can think about here is that if we are in those sidewards phases, we might even go with long and short trades simultaneously. That will be a very strange concept, but let's see what it means. So, still going for the cons. If the price goes constantly in one direction, then of course we will have a loser trade. And those trade lines will happen again. We know those will happen and will happen always, but maybe not that often. Let's think about that. And now it comes to the taming of that approach. And I simply call it taming because I have no better word. But anyhow, so what are our criteria for advantages? So stop loss as a risk limitation, got it. As always, we know we are trader, we have stop losses. But think once again about those sidewards phases. Maybe there are special underlyings which have a tendency for that sideward markets, just going a little bit up, going a little bit down. And you may already have some ideas of special underlyings which will look like that. Think, for example, about Euro Swiss franc. Normally, that's a quite boring underlying, not doing anything more or less. Might that be an ideal candidate for that kind of trading approach? So now we do more or less exactly the opposite of what we normally do. Normally we look for trending underlyings which go in one directions. No, in this case, maybe a selection go for an underlying which is just wiggling around would be ideal, because then we can do that absolutely strange concept of maybe going long and short simultaneously and manage the long side independent of the short side. Both get risk value, and then we do exactly what we discussed with the DAX prices. And of course, if now we don't have luck and the price goes into one direction more or less straight, there's one trade will be a winner, and because that one which was in the right direction, and the other one will be the loser. And in case like risk reward ratio of 5, finally that would mean we will lose money. But if that happens not that often, hey, now it becomes interesting again. And on the other hand, think about what we discussed, for example, for power candles or EMAs. I think that will come in later webinars. But let's rethink about power candles. What did we discuss, and what did we discover? We discover that there are some edges, some probability advantages if we have those kind of power candles that we see, hey, good. Now we have an edge into one direction. So let's go for a trade exactly into that direction and manage that trade by this kind of approach. And now what is good? We have an edge, a probability advantage, but that Martingale approach makes us a little bit more error tolerant. So even if the price goes down, let's once again think about a long trade, the price goes down once again, and we have a long trade. Since we rebuy and we do that kind of sequence, we might even get that trade still into the profit region. Good. That's both is interesting. Looking for special underlyings and looking still for trading edges, because even mathematically, if we have an edge in that concept of Martingale, then the number of big losers will go down. We can simulate that. First, 2 Excel sheets come now. Let's go for that kind of concept here once again. Let's think we have a probability advantage of maybe 0.6. So we have a real probability advantage. And now let me simply press sometimes F9 and we look how often we survive within that sequence here. And you see, now was the first time that we would not survive. But now the tricky part comes simply by applying risk management. And looking for a trading edge might be a good idea to get that kind of concept really working, like within that Excel sheet. So even normally such a trade, we would end with a loser trade. That trade, now we can turn into a winner trade once again. That is trading with edge. And then we can do a selection, or we use that bias for a long or a short trade. But we can do something else. You remember that I said, hey, are there currency pairs which have a tendency for sideward markets? And I know we have hundreds of numbers here, but let me explain, and then we simply sort the table, and you will quickly realize how we can already get an edge by selection of the right underlyings. So what I have done is I look for H1 data, so hourly based data. And I asked myself, and I wrote a short program for that, within 120 candles. Okay, well, let's do it the other way around. So we go back into the history at a certain point, and then we ask, within the next 120 candles, what was the typical maximum distance to the north and the typical minimum distance. So there's a range of that price created by the next 120 candles. And I did everything here in relative, so let's call it percent wise. That means the typical range to the north is 1%, and the typical range to the south is 1%. Good. And you see already, if I go down here the list, in this case to gold, hey, it's double the value. So you see already, gold is more creating bigger ranges here within 120 candles. And that's the average for the last 14 years. Okay. And let's see how we can go with that kind of concept here. Because we can ask another question. How often if we start our consideration at a certain point and we look for the next 120 candles, how often do we come back to our point of interest? So let's call it the start position. How often do we cross that level once again? That would mean the price went, for example, up and then came down again to my original point. And now let me sort that table for that number average count cross. And then we will see, we get a clear picture of our underlyings. And what you can see is, okay, let's go down here the road. Within 120 candles, in average, over the last 14 years, the Euro-Swiss franc has been the most, the best one, always coming back. And on the other side, we see currencies like British pound, US dollar, euro, US dollar. So, and here down the road, others would be New Zealand dollar, Canadian dollar, and so on and so forth. So simply sorting my underlyings to that criteria, coming back, that's more or less that kind of criteria. How often I come back to my point of interest within 120 candles, which by the way is exactly 1 week. So you see that Euro Swiss franc is much more often coming back to that point. So that kind of currency or that kind of underlying is much more stable because it goes up and comes back. So for that long short simultaneously concept, those would be ideal candidates down that road. Exactly on the other side would be the one, hey, we only trade into one direction because they are more trendy, let's call it that way. And then you will see pairs like, especially those with Japanese yen, those kind of currency have a tendency for trend behavior, going in one direction and not come back that often. The difference between those underlyings is quite huge. So we have now candidates for more straight behavior on the upright of the table, and here down the road we have those candidates for wiggling around, going long short simultaneously, and then we can use that. And now it takes me some seconds, and I hope I will be fast enough here to get it, because unfortunately I didn't open those documents early enough. But give me a second, because I can tell you that I have already some equity curves out of that concept, and let's go for maybe just let's start 1 second. Let's go for it. So we go for long short simultaneously, and let me just pick one example here. And those equities here we would get finally. Still, we have equities, and that's for more than 10 years, following that kind of concept. And you see in violet here, Australian dollar, Canadian dollar, hey, works quite well. Sometimes we hit our final stop loss, and then we get those steep going south in our equity, but more or less it goes stable upwards, just with that kind of concept. And if you look for the selection of currency pairs, hey, it's more or less exactly the table we talked before. So it really looks quite well. That's, by the way, the combined equity of all of these, and just other examples that you can see, hey, the kind of concept is definitely not that bad. and it really looks quite well. So let me summarize here. Trend behavior on the upside of the table, not trend behavior here on the downside, and candidates for that long short simultaneously. Since I have a question here, just a second, to bring that a little bit more transparent, just a second. That kind of concept with long short. I have something here which I can show you for that, and that makes the concept maybe hopefully a little bit more visible. But still no problem, because what we have is we have that the live experiment, what we will do in a second. So now here we go. And now we can look here for that concept. Just a second, and here we are. So let's go for this example. That we have really equity lines of that kind of concept just for one currency pair, and that is New Zealand dollar, Canadian dollar, which is within that list as well. And you see what happens with those kind of equities. Sometimes, and those equities are with floating, therefore we still have those spikes. You remember, those spikes down are always or make already the concept of Martingale strategies quite visible, and take that as a hint. If you look for my FX books and look for other people trading, whenever you see quite well performing equity lines, always ask for the equity and not look for the balance, because only in the equity you can see those spikes. So and if they are too huge, then be careful. So you see how it works. From time to time, we suffer our panic stop loss, our overall stop loss meant for our risk calculation. But most of the times we can recover those spikes, and we go for those kind of equities really going north in a very good way. But this kind of concept, going short and long simultaneously, will only work if we are in those sidewards phases. And in this case, we have a currency pair which is perfect for that kind of approach. Good. I mentioned that I want to show you that even live. And now we go here for a demo account, and still this is in the test phase, and I will make an experiment right now here as we speak. Only a couple of days I have the expert advisor ready, thanks to Peter Müllner, who has created that. But let's see how that concept works. And now we do it live, not within those charts. Even those are interesting as well, because we have already groups of trades, and then finally those trades have been profitable as well. But now let's go just live. And I go for a currency pair which is extremely not suitable, but in this case I like it, because what I now need in order to show you the concept is simply I want to have, let's call it action. In this case, normally, finally, by the way, this strategy will not run on M1, but I now opened it here in an M1 window. And now you see what happens here. Let's go for live. So we opened two trades, one short trade and one long trade. And I repeat myself now, Euro Japanese yen is normally not a good currency pair for that. But let's go for that, because normally we have a little bit more action there. And hopefully we get enough action during the next minutes during talking here that you see how the strategy really works. What you can see here already is, okay, we have two take profits. And there's one take profit for the long trade, which is here. And there's one take profit for the short trade, exactly here. And now if we get a little bit more action here, at least in one direction, we can look for those rebuys. Up to now, it has not happened because the price is still at the same level. So therefore, there's no rebuy. And both sides, long and short, we manage independently. But we can do, in the meantime, something else. We can look right now when we opened absolutely the first trade, where my there we are. When we opened just the first trade with 0.01 lot in this case, the stop loss is far away, really far away. And that stop loss we would not reach, even not within months from now. But that's how it should be. Starting with a stop loss, which is really far away. And you can see for this stop loss, I have a value of a risk of, and now I hope I get a number here, but I can tell you the number. The number is 200 euros, as you see here. So 200 euros is my panic stop loss. So that is the total amount of money I have now on risk. Since I have two sides, it's 400. If now a next trade would be opened, which is unfortunately not the case here because we have not enough movement in one direction, then therefore let me show you a little bit what would happen with my stop losses. Since we cannot see it here, since we don't open a new trade, it's not the best timing to do the webinar at hours which are quite calm. But let me simply put the line here. So if we now, because that is the stop loss of the short side, if we would now open a next short trade, which would be once again 0.01 lot, then the stop loss for each of those 0.01 trades would go down exactly to the half here. And then further down the road to 1/3 and so on and so forth. So you see, stop loss would come towards to my price, okay. But on the other hand, my take profit would come towards my average entry price as well. Let me give it a second, but I think still there's not enough action, unfortunately, that we don't have a rebuy here. Let me look whether I can find a nice example, maybe out of those M5 charts. And once again, finally, that kind of strategy would not run on those tiny things. But okay, I will at least give it a try to look to British pound, Swiss franc here, but now we have already too many trades open in order to discuss exactly what I would like to discuss here. But at least what you can see, the take profits values are already quite close. So now what we need is maybe one move to the north, then all the short trade, all the long trades would go to profit. Maybe we get one move to the south, then all the short trades would go for profit. That's how this kind of concept always looks like. Normally we get those group trades, and when those group trades have a couple of red lines and a couple of green lines, then the group of trades is finally a winner. Only if we have only one color, then we would have hit our panic stop loss. Still, that account, and up to now, it's just test phase of those expert advisors in order to get that strategy up and running. Will run completely differently finally, not with that kind of settings, not with that kind of time frame. But we know now that there are currency pairs which have a good perspective for that kind of approach. And we can go for all the other approaches as well, like using the power candles or other trading edges as well, with some probability advantage into a certain direction. And then we would not go for that long short group, just only in one direction. Still no movement. Maybe what I can show instead, because here exactly a minute ago, a trade ended in a profit, and for euro US dollar, we have had that kind of sequence here. The initial trade has been started here. At that point, we opened a long and a short trade. And since the price went down, there was a rebuy into the long direction as well. All those little arrows here showed that we have a rebuy. Then my short trade already was in take profit. Okay, good. And then we got that pullback here. And finally, that sequence of long trade have been profitable as well. The sum of all the lines. So you see we have a couple of green lines showing that we have profitable individual trades and one red line. But I look for those trades always as a group of trades, and that group of trade was profitable at the very end. The Japanese yen still not working, but anyhow, that's the moment markets calm down. And if market totally calms down, then we will not have anything what happens. Good. So let me go for the summary now. So what Martingale Strategies is about, first thing to mention, it's a no-go. The bankruptcy will be with guarantee. If you just play that game of doubling without any limit, then you know what will happen. And I showed it several times in the Excel sheet, and I hope you remember always that just going with that strategy without anything else is not good. But we have now seen a few things which tame that Martingale concept. And what you see here is that, of course, we always need a stop loss, as always. So as for all the trades we do, so stop loss is a must. But now that kind of concept becomes especially interesting for sideways phases. And I can tell you the number, most of the time, underlyings are in more sideways markets than in trendy markets. So we have a good concept now for that sideways moves. And then we can go, for example, with that long-short simultaneous strategy. And there are other ways what we can do. Think about there's a long range, and then if we would come down to the lower end of the range, then we would trigger long trades, and on the other side we would trigger short trades. Even a cool concept as well. And the good thing is, even if we go for trading edges like trend behaviors, so we open the trade into the direction of a trend, for example, then our group trade becomes more error tolerance, or gets more error tolerance, because if we have such an edge, then a pullback is already enough to bring that trade into a winner trade as well. So it's a cool concept, but still be careful. Whatever you do with something like Martingale, use it up to now more from a conceptual perspective, but have a look to sideways faces and those kind of underlyings which really behave more like that. And due to that statistical analysis of a couple of underlyings, you saw there are quite good underlyings for that kind of approach at all. So very nice, very interesting. I hope you enjoyed the webinar. Let me quickly, before going to the end, have a look whether my Japanese yen has opened the next trade. No, unfortunately not. We're still not really going away from the price of entry, so therefore there's no need to rebuy anything, either the short nor the long trade. So it seems like it will stay there forever, at least up to now. Now we get a move, since I want to finish the webinar. But you see now it happens already. The other side. So life experiment is not that good, but the market is now too calm for any moves. So, um, but I hope you understood the concept and take it conceptual, take it as an additional input, and hopefully with the next webinar from me or my colleagues, you are here once again. So see you, have a good time, and at least for today, a good evening. Goodbye. Bye-bye.